Hey guys, welcome to another Life Success Factors video. I'm Craig and I wanted to welcome you to this video. If you're a new subscriber, hey there, I'm so glad that you've joined us on this journey of personal development. If you're a returning subscriber or a returning viewer, then I wanted to welcome you back, and I'm really hoping that you're enjoying the content that we're putting out there for you. So in today's video, I wanted to talk about my investment philosophy and how I got started investing, and why you should also start to invest in 2026 if you haven't already done so. So if you're interested in leveling up your investment life and learning a little bit more about personal finance, personal development, and money management, then this video is for you. So in today's video, I'm just going to be talking about how I got started investing and some tips and tricks that you should keep in mind as you're going along on your investment journey. So let's get started. How did I start investing? Well, I started investing a lot later than I should have, or that I would have liked to. And this wasn't because I lacked the intelligence or I didn't know about investing and stocks and growing my wealth. The thing that stopped me was actually not taking action. And I vividly remember a conversation that I had with colleagues, and I think this was probably in late 2016 or early 2017. And I was very early in my career at that time, and I was still learning the ropes. I was learning what it meant to be a good and effective consultant, but I hadn't focused on my investing journey and my wealth journey. And I think I was probably lacking in some skills around personal finance and money management. But going back to my story, I found it really hard to keep up with the conversation. My colleagues were talking about all of the stocks that they had invested in and the rationale for why they had invested. And I remember just being lost in that conversation. I couldn't contribute. And I felt really strange because I had studied finance at university and I thought I had somewhat of a money brain or a numerical brain, but I hadn't really focused on that area of my personal development. And so I set to myself from that day forward that I would focus on leveling up my knowledge, my insight into personal finance and into investing. And for the next 3 weeks, all I did was consume financial content on YouTube, on books. And I remember reading 3 books that were really pivotal for me at the time. The first was Money Master the Game by Tony Robbins. The second one was The Intelligent Investor by Benjamin Graham. And the third was Think and Grow Rich by Napoleon Hill. And I won't cover what those books were about, save to say for the fact that they were all about how you could develop your mind as an investor and grow your wealth. And I strongly encourage you guys to not only read those books, but read widely. Educate yourself about finance, about money management, about investing, because doing so will compound your returns over time. It'll make you a better investor, and it'll also mean that you are able to set yourself up for a very strong financial future. So anyway, going back to my story, I read a lot. I educated myself about what it meant to grow wealth and what the secrets of the wealthy were. And when I finished that little period of reading, I realized that it wasn't as hard as I thought it was. And in fact, there are really no secrets to building wealth, but consistent action and discipline. And this leads me into my next point around, investing is really about behavior. It's not about intelligence. Now, a lot of people will say that you need to be very intelligent when you invest, and you've got to be able to read charts, and you've got to trade in and out of stocks. I'm here to tell you guys, when I started, it was probably the simplest thing that I did was a buy and hold strategy. And I strongly believe that when you keep it simple, you reduce the complexity, and you don't get tangled up into all of these weird and wonderful investment ideas that 9 times out of 10 they just go to zero, guys. So what did I do when I started investing? Well, I invested $1,000. I started small, and I think that's something that was really powerful for me at the time. And this is one piece of advice that I'd give my younger self, is that when you start small, when you start with a small step, it's amazing how much momentum that you can start to develop by taking this first step. Now, if you've watched some of my videos, you know that I'm a big fan of personal development. And personal development is all about doing the little things and having those little things compound over time. With investing, guys, it really is about compounding your consistent investments day in, day out over time. And, starting small doesn't matter, because it's not about where you start, it's about where you end. And I started with $1,000, and I think I split that equally between 2 stocks. And these were both Vanguard ETFs, or exchange traded funds. If you guys don't know what ETFs are, I'll do another video that will go into a little bit more detail on ETFs and the different types of stocks out there. But essentially, ETFs are just a collection of stocks that may track an index. So I'm in Australia. The 2 Vanguard ETFs that I bought were listed on the Australian Stock Exchange, or the ASX. If you're watching this from the US, then you may choose to buy stocks that are listed on one of your local exchanges. I'm not a financial advisor, so I can't give you financial advice, but some of the things that you could look into to educate yourself about these things is to read some financial publications, and I'll link to some below, and they're quite widely known. But I invested in those 2 stocks. And I think one was VAS, the ticker symbol VAS, and the other was a ticker symbol VGS. Now, VAS was tracking the top 300 companies in the Australian market, and VGS was tracking a few hundred companies in the international market as well. So not only did I get some local exposure, but I got some exposure to some international companies as well. And looking back, I think that was probably one of the best decisions that I made, because despite the fact that I didn't know a lot about investing at the time, I found that taking that one step was absolutely pivotal to me being invested in the journey, or having skin in the game, as they say. And it's amazing when you're invested in something, and I'm using that in double quotation marks. When you have, let's say, a piece of the pie, you're more vested in the outcome. And investing in those 2 stocks meant that I was really curious about how they were performing day in and day out. Were they up today? Were they down, today? Why were they up, or why were they down? I think, you get curious, and I was very curious. And, the more I learnt, the more I took interest, and the more I, let's say, grew my conviction in my investing philosophy. And it also helped me right-size my risk tolerance. And this is another really important point, guys. When you start investing, or when you're thinking about investing, one thing that you should really do is to think about your tolerance for risk, because all investment comes with risks. And I'll say that I'm not a financial advisor, so I can't give you specific financial advice. And I encourage you to read widely and consult a licensed professional. But educating yourself on what you're thinking about investing in is something that's really powerful and something that I haven't seen a lot of people do or do well. So, as I had invested in these two stocks, I was reading more widely. I was thinking about my risk, and knowing what your risk tolerance is helps you to make better decisions. Where someone else sees a particular risk, you may see an opportunity, or where you see a risk, someone else may see an opportunity, because they've got specific information that could help them better make that call. Now, I'm not saying every stock is for everyone. It's really about your personal financial goals. But I used my curiosity to my advantage, and I started to get really curious about other sectors, not just ETFs or the broad market index, but other sectors. And, there's thousands and thousands, if not hundreds of thousands of different stocks out there, guys. So, it doesn't mean that you have to be invested in all of them. In fact, the most successful investors keep it simple. And some people say that you should diversify. Well, it really depends on your personal financial goals, and diversification makes sense for a lot of people. But oftentimes, being really simple, investing in just a few stocks, can work for others as well. But I think the importance is to really be clear about your investing goal and your level of risk. So going back to my story, I was really curious about other sectors, and I started to read up, and at the time there was a lot of renewed interest in the tech sector. Let's say in 2018 and 2019 in Australia, with companies like, Afterpay coming onto the scene, and, what some may call revolutionizing buy now, pay later services in Australia. And I remember buying into Afterpay at a really low price. And, after a few months, it had almost doubled, and I hadn't made a big investment. But I remember saying to myself, well, I could just buy and sell when the stock goes up, and I could keep repeating that with different stocks. And so, I did, and I'm giving you my personal experience. And, while it was great, I think I made a few $100s. It wasn't a whole lot. But then about a year later, it basically went up by 10 times my initial buy-in price. And that was a really pivotal moment for me, because I said to myself, geez, if I didn't sell, then I would have 10x'd my return. And, I did. I must admit, I did feel a little bit of regret that I had sold. But, it was a really important lesson for me. And, it's an important lesson that you should also heed, in that sometimes when you make let's say a very quick decision based on an emotion, then you may not necessarily get the best outcome or the right outcome for your situation. And so this leads me into my next point, guys. With investing, it's really about behavior, not intelligence. And I'm here to say that intelligence is not the thing that will set you apart, but being consistent and disciplined about your investing is the thing that will lead to you getting better outcomes for yourself over time. So I'm a big proponent of dollar cost averaging, which is essentially, buying consistently, whether that's each day, each week, each month, but buying regardless of if you have conviction in a stock and you understand its risk-return trade-off, but buying at a consistent rate, no matter whether it's up a little bit or down a little bit, but over time you're investing so that you buy consistently in your, some days you may pay a little bit over, but other days you may pay, a price that reflects an undervalue of the stock, and this helps you get some outsized returns because you're investing when prices are lower than the stock's intrinsic value. And it's a behavioral thing because oftentimes if we see a stock go down in price, then we say, well, something must be wrong with it. But in fact, volatility can be your friend. And just because the price of a stock goes down, it doesn't mean that there's something wrong with the company. It may just be something in the market that's causing it to go down in value. So Warren Buffett actually famously said that you should be greedy when others are fearful and fearful when others are greedy. And this was a really important point for me to bring up, guys. Sometimes you need to think counter cyclical, or you need to take a bit of a contrarian view because oftentimes things aren't as rosy as they seem, and sometimes they're not as bad as they seem. But the one thing that I've learned with investing is that there is a lot of emotion that's involved with a large part of how people think about investing and the market. And the best thing that I could have done is to remove the emotionality out of any investment decision and just think objectively about what could be possible and what could go wrong, or what could be a challenge with an investment. And this goes not just for things like stocks, but other assets like property or cryptocurrency or Bitcoin. It's really about educating yourself and thinking, well, how can I make the best decision objectively based on the facts that I've got in front of me? And if you combine that with being disciplined and consistent, that's a really powerful combination for you as an investor and you developing an investment mindset. And the final point that I'd like to make, guys, is one thing that I've learned over the years is to focus on quality, not quantity. Now, there's no right number for the number of stocks that you need to have in your portfolio. I probably have too many stocks in my portfolio, but I've noticed that the majority of my returns have come from a handful of companies, and from a handful of companies that I would not have necessarily picked to have done well over time. But, I had some level of conviction to say, well, there might be a possibility that this could do really well, but maybe the central case may be that, the stock that I was investing at the time might generate a standard rate of return, risk adjusted. So focus on quality, guys. You don't, as I said before, you don't have to be invested in all of the companies, but focus on the companies that you know something about. If you've got a low risk tolerance, well, then consider whether you should be looking into more volatile sectors such as energy or new technology, because investing in these sectors sometimes come with greater risk than investing in what are traditionally considered more blue chip sectors, such as financials or telecommunications or utilities, where the companies there have more predictable cash flows, which means that their prices are not subject to the same level of volatility as companies where they're at early stages of growth, or in higher risk, let's say sectors or industries where technology may not be proven, but there's very high expectations, and any hint to the market that these companies may not necessarily hit their targets might mean that their share price gets hit whenever some of that sentiment sort of starts to creep in. So look, I know that some of these concepts might be a little bit more advanced for you if you are starting your investment journey, but take this as some motivation for you to read more broadly and to think about those books that I talked about before. And I'll list them in the description below. Money Master the Game by Tony Robbins, The Intelligent Investor by Benjamin Graham, and Think and Grow Rich by Napoleon Hill. These are three. There are so many out there, and I encourage you to read widely. Another really good one is Rich Dad Poor Dad by Robert Kiyosaki, which was a really good book to that taught me the importance of assets, of owning assets, not liabilities, but focusing on the things that will appreciate over time rather than lose value over time. And this is really important. If you are early in your investing journey, or let's say you've just come out of college or university, and you're thinking about the next stage of your growth, here at Life Success Factors, we're all about empowering you with the knowledge and the tips and the tricks to help you make the most out of your life. And at the end of the day, make sure that you live a fulfilling life that is filled with the things that matter to you. So look, I'll leave the video there, guys. I hope you got something valuable out of it. Let me know what you thought about the video in the comments below. What are your thoughts on investing? Have you started your investing journey? Are there things that you want to learn more about? If you want me to cover more topics like this on the channel, then let me know. What's something that you're interested in with regards to investing that you would like me to cover. I'm more than happy to respond to your comments and create more videos like this one if you think that it's helpful. With that being said, guys, enjoy the rest of your day, and I'll see you in the next video.